Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, and this is part 11 of our 12-part series on investing in Oklahoma City real estate. We're getting towards the end here, and what we're talking about is a unique type of an exit strategy that I think is pretty cool that allows you to sell your property and reinvest that property into more real estate without paying any taxes. In the previous video, we talked about your cash out situation where you pay a 25% recapture tax on the depreciation that you've taken over the course of the time that you've owned the property, and then also paying capital gains. Well, there's a way of not paying either one for the rest of your life, and that is the 1031 exchange. Now, it's called a Starker exchange, is what it used to be called, because that's the family that sued back on the IRS and actually won. Somebody won against the IRS. And this is where certain parameters were set up that allow you to do this. So, you know, what the IRS is basically telling you is, okay, you've got to take every dime that you made on that property and you can't touch it once you sell it. In other words, you can't put that into your account. It's put into a third-party accommodator's account. We'll talk a little bit more about that here in a minute. So let's say that is $50,000. And so now what we have to do is we have to identify a property or properties that you want to purchase, and that's got to be done within 45 days of that closing. And so let's say we have that theoretical $50,000 and you want to buy two really good buys at $100,000, and you know there's $25,000 each in terms of closing cost. You can take that and you can divide 25 and 25. You know, it doesn't have to be that way. It can be 30 and 20. It's however you set it up, and you've got to spend the total dollar amount, and you've got to spend at least as much as what the sales price was of the property that you sold. And you can buy up to 3 properties in this respect. Now, the good news also is that you've got 6 months from the time of closing to close those properties. 45 days to identify, 6 months to close. Now, normally it's not going to take that long. And that way you now have 2 sources of income from that one source of income without paying any taxes. It's kind of like the IRS saying, hey, you know, I'm going to give you $50,000 tax-free and interest-free in order to invest in more real estate. And it's really a great idea. You know, it's not like the IRS is in trouble on this. It's like, you know, this is great because this creates income for other people. It creates taxes. So it's not a loss in that respect. It's really a gain. Now, you can do this for the rest of your life. You can keep exchanging and exchanging and exchanging. I hate to say this, but of course the ultimate tax dodge is dying. Now, I know that's not a pleasant thing to talk about, but essentially what happens, and this is kind of the cool thing too, is you've had all this income building up with the 1031, and then at that point it goes to your heirs, and the basis starts over. In other words, it's like they're buying it fresh, and they're getting the advantage of that 27.5 years depreciation schedule. So that is essentially what a lot of people try to do. They take that 1 and it becomes 2. They take that 2 and it becomes 6. They take that 6 and it becomes 18. And this is the way that with your cash flow, you can build an appreciation. You can build up that income, not have to pay taxes, and make your personal portfolio better and better and better. Now, there's another thing called a reverse exchange that I'm not going to go into. A lot of people don't do that, but we're really going to talk about that when you and I get together. The last thing I would say about a 1031 tax-deferred exchange, it's a like-kind exchange. So when that is a definition of like-kind, it doesn't mean, well, I've got to do a single-family home for a single-family home. You can also invest in other kinds of real estate if you want. You can do a duplex, or you can do a quadruplex, or whatever it happens to be. So it doesn't have to be exactly the same property. It's just got to be in the same family to a certain extent of an income producing property. Now, there's some people that have tried to expand beyond that. We don't do that. We go the safe route with you. We take real estate to real estate. We go that direction, but it's a great way to build up your portfolio. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.